Most people do not become poor because they never heard about investing. They become poor because when the great buying windows finally open, they are emotionally unprepared to walk through them. That is the real story, not a lack of information, not a lack of intelligence, a lack of emotional preparation. I have spent enough years around markets to know that the public always tells the same story at the wrong time. At the top, it says this time is different because prosperity has become permanent. At the bottom, it says this time is different because the system has finally broken for good. Both stories are comforting, and both stories are usually expensive. The market does not ring a bell and say, now the fear is excessive, now the bargains are real, now the price is below the value. It throws people into confusion, it shakes them, it embarrasses them, it makes the strongest companies in the country trade as if they have lost their future. That is the moment. Not when the newspapers feel kind, not when the experts sound balanced, not when your neighbor says he is buying again. The moment comes when fear has become respectable. That is when ordinary people, if they have cash, patience, and a plan, can do extraordinary things. This is why I want to talk about what is happening in the market when prices collapse. Not because I enjoy fear, I do not. I dislike fear in markets, the way I dislike smoke in a house. It means people stop seeing clearly. But I respect one thing about fear: it creates windows that optimism never would. That is the part most people never learn. They think wealth is built by finding secret information or by owning some mysterious high-growth stock before anyone else notices it. Sometimes that happens. More often, life-changing wealth is built by doing something much less glamorous, buying strong assets when the whole world is emotionally incapable of pricing them rationally. That is the pattern. The last time this happened, many regular people became millionaires, and the time before that, and the time before that. That sentence sounds dramatic until you study history long enough to realize it is not dramatic at all. It is routine. Market crashes are not random theater. They are recurring episodes in which human fear temporarily pushes prices further down than business reality deserves. The people who understand that do not need insider information. They need nerve, they need context, and they need a plan already written before the blood hits the screen. That is the whole game. I want to take you back to 2009. The mood then was not pessimism in the casual sense. It was despair. People were not merely worried. They were mentally rehearsing the end of the financial world as they knew it. Homes were being lost, banks were failing, jobs were disappearing. Television did what television always does when panic is available. It magnified the panic. The S&P 500 had collapsed to levels that made ordinary people feel they were living through something almost biblical. Apple could be bought at prices that now sound absurd. Amazon was trading at levels that, in hindsight, feel like a prank. The S&P 500 itself was around 670. And yet the companies inside it were not piles of ash. They were still selling products, still generating revenue, still employing people, still doing the ordinary work of business while the market treated their future as if it had already been canceled. That is the first principle I want you to understand. Price is not the same as value. At the peak of panic, people confuse the two because fear is persuasive. Fear tells you that the current price must reflect some deep truth about the final destination. Often it reflects only the current temperature of human emotion. That is what 2009 really was, not a magical buying moment visible to everyone. A period where price and value were violently separated by fear. And people who could see that separation and act on it changed their lives. A $10,000 investment in the S&P 500 from those depths later became more than $70,000. That is not a trading trick. That is not gambling. That is not genius. That is the result of buying productive assets when they are being sold as if they are permanently broken. Now let us go back further. March 2000, the internet bubble bursts, technology stocks collapse, and suddenly the same people who had worshipped everything with a .com attached to it begin speaking about the entire internet as if it were some passing fantasy. That is what crowds do. At the top, they project infinity. At the bottom, they project extinction. The Nasdaq fell more than 75%. Amazon dropped from levels that had once made people feel euphoric to levels that made them feel stupid for ever believing in it. Cisco, one of the great networking names of the era, was crushed. And once again, the public told the same bedtime story it always tells at the bottom. This whole thing was overrated. This whole thing was a fad. This whole thing is over. The prices had collapsed. The future had not. That distinction matters more than almost anything else in investing, because the market can be very wrong about the pace of a theme and still be right about the importance of the theme itself. That is why I have always tried to separate two questions. Was the excitement excessive? And is the underlying trend still real? Those are not the same question. In 2002, the first answer was yes. The excitement had been absurd. But the second answer was also yes. The internet was still real. Digital commerce was still real. Network infrastructure was still real. And the people who bought into that wreckage after the air had been let out were not buying a fantasy. They were buying reality at a discount. That is where fortunes are born, not when a trend first becomes fashionable, when a real trend survives its first public humiliation. Now let us go back again. October 1987, Black Monday, a 22% drop in a single day. Imagine that in real human terms, not as a chart, as a body feeling something. People watching retirement accounts collapse in one session, brokers crying, traders shocked, television soaked in catastrophe, and the language once again was final. This is the end. The whole system is broken. Capitalism itself is under question. That is the language panic prefers. It never says, this is a violent repricing, and within a few years much of this will look very different. Panic always says final things, but the market recovered, then it doubled. And the people who bought during the crash or simply refused to sell into it were rewarded not because they were lucky enough to avoid pain, but because they understood something stronger than pain. The American economy is not the same thing as a week of fear. That is a hard lesson to learn because fear is vivid. Recovery is slow enough in the beginning that people do not trust it. But that is exactly why recovery is where the money is made. The best gains often do not come when everything feels good. They come when things still feel terrible. But the market has begun moving before the public is emotionally ready to believe it. This is why so many people miss the easiest phase of a new bull market. They wait to feel safe. By the time they feel safe, the bargains are gone. That is not the market being unfair. That is the market charging an entrance fee called discomfort. Now let us ask the most important question. Why does this keep happening? Why, decade after decade? Do regular people get a chance to buy very good assets at very bad prices? The answer is not finance first. It is psychology first. Markets are not just machines of valuation. They are theaters of human emotion, greed at the top, fear at the bottom. And in both phases, price moves faster than sober analysis. When greed takes over, people buy because they do not want to miss the party. The more prices rise, the more social proof expands. Then eventually, the music changes. A recession, a scandal, a rate shock, a debt crisis, a war, a disease, some trigger always arrives, and when it does, fear takes the wheel. People sell not because they carefully recalculated the intrinsic value of great companies overnight. They sell because the pain of uncertainty feels larger than the logic of patience. That is the entire mechanism. Fear and greed are not poetic words in the market. They are pricing forces. And if you do not understand them, you will keep acting rationally in ordinary life and irrationally in the one arena where patience matters most. That is why I have always loved Buffett's line about being fearful when others are greedy and greedy when others are fearful. People repeat it like a coffee mug slogan. It is not, it is a field manual. It is saying something brutally practical. When greed has driven prices too high, your future returns shrink. When fear has driven prices too low, your future returns expand. That is the whole equation. And yet almost nobody can live by it when the moment actually comes, which is why the opportunity keeps recurring. If it were easy, everybody would already do it. Now I want to bring this down from theory to human scale, because one thing the source material did well was remind you that this is not only about hedge funds and billionaires. Regular people have used this pattern to change their lives. A teacher in Ohio, a construction worker in Texas, a nurse in California. These are not the usual heroes of market mythology, which is exactly why they matter. The teacher had about $15,000 in 2009, not millions, not family office money, just $15,000 she had protected and not wasted. Everyone told her to wait. Do not invest now. Too risky. What if the market falls another 50%? What if the economy is really finished? That is how ordinary people talk at bottoms. They mistake the visibility of danger for certainty about the future. But she had done something very rare. She had studied previous crashes. She understood the pattern. She knew that severe declines were often followed by strong recoveries, and that broad index funds offered a way to bet on the recovery of the entire American business system rather than on one company. So she bought the S&P 500 through a simple index fund and held it. No day trading, no drama, no genius. That single decision later turned $15,000 into more than $90,000. That is not a miracle. That is preparation meeting history. Then there was the construction worker. He had $25,000 in retirement savings and borrowed another $10,000 from a home equity line to add to it in 2009. His friends thought he had lost his mind. This is important because the crowd always thinks the buyer at the bottom is insane. That is one of the signals. The buyer at the top is celebrated. The buyer at the bottom is ridiculed. That is how you know which side of the cycle you are probably standing on. Now, I do not recommend casual leverage to ordinary people. Let me be very clear about that. Borrowing to invest is not some universal shortcut. It is dangerous if not handled with real math, real income stability, and a real plan. But what matters in his story is not the leverage itself. It is the conviction that the odds were not random. He knew he could pay back the debt from work. He knew the market had never stayed down permanently after previous large crashes. He knew that fear had created a gap between price and long-term value. That combination produced a calculated risk, not a casino move. Years later, the payoff was dramatic. But again, the lesson is not borrow money. The lesson is know what you are buying, know why the crowd hates it, and know why time may be on your side. Then there was the nurse during 2020. The COVID crash was different in speed, but not in emotional texture. The market fell more than 30% in just 23 days. That kind of velocity does something ugly to the human nervous system. A slow loss is one thing, a violent, sudden collapse makes the market feel like a trap. Airlines were grounded, restaurants were shut, people were talking about the Great Depression again. Experts were predicting years of misery. And yet, once again, a prepared person with cash and a framework could see something the panic majority could not. The world was in crisis, yes, but the whole productive base of the American economy had not been vaporized. Good businesses would survive. Index funds would still represent the total market. If history was any guide, the recovery would begin before the mood improved. So she put $30,000 from savings into broad market funds. Nothing fancy, nothing heroic, just the S&P 500 in total. Market exposure. And in less than 2 years, that money more than doubled. Again, not because she possessed a secret, because she possessed calm when calm was expensive. That is what the bottom pays for, not brilliance, preparedness. Now, I want to slow down here because this is the part too many people skip. Looking back, it always seems obvious. Of course, buying in 2009 was brilliant. Of course, buying after the dot-com crash was smart. Of course, buying in the COVID collapse worked. That is hindsight talking. In the moment, it never feels clean. That is the point. The reason most people do not build wealth through these cycles is not that they never heard the strategy. It is that when the opportunity arrives, it arrives wrapped in fear. You are watching your account drop. You are hearing terrible headlines. Your friends are hiding in cash. Experts are forecasting more pain. And your body is telling you that safety means waiting. That is why the plan must exist before the crash. This may be the most important sentence in the entire discussion. The buying plan must exist before the fear arrives, because if you wait until the crash is already happening to decide how you feel about market history, about valuation, about your time horizon, about how much cash to deploy, about which assets to buy, then you are already too late psychologically. The fear will make you stupid. That is not an insult. It is a human condition. Strong price declines shrink cognition. They make the near term look like forever. That is why prepared investors are different. They do not improvise under maximum emotional pressure. They pre-commit. They decide in advance that if the market falls a certain amount, if high-quality assets go on sale, if they have long-term money available, then they will act in measured stages. This is what gives them their edge. Not secret knowledge, pre-decided courage. Now let me say something even more important. You do not need to be a genius for this. That should comfort you. You do not need a Harvard finance degree. You do not need to understand options theory. You do not need to build valuation models on 20 companies every quarter. Most professionals cannot consistently outpick the market over long stretches. That is simply the truth. The data has humbled more experts than amateurs care to admit, which is why broad index funds remain one of the great wealth tools for ordinary people. If you buy the S&P 500, you are not making a grand statement about one management team or one product cycle. You are buying the earnings power of the largest companies in America. If you buy the total market, you are buying the broader productive engine. That matters because recovery becomes easier to capture when you stop pretending you need to be a prophet. You do not need to identify the next Apple at the exact right moment. You need to own the system when the system is being sold too cheaply. That is a far more achievable task. Now let us get practical. How do you recognize one of these moments while you are inside it? not by waiting for a headline that says, "This is the generational bottom." That headline never comes in time. You look for a few things: extreme pessimism, not regular bad news, extreme doom. The kind of language that says the economy is finished. This time is different. The whole structure is broken. You look for major indexes down 30, 40, sometimes 50% from their highs. Not ordinary 10% wobbles, real crashes. You look for fear in your own stomach. That is very important. When you feel the urge to sit in cash because investing suddenly feels dangerous, that is often when valuations are finally beginning to get interesting. Comfort is usually a sign of expensive prices. Discomfort is often the entrance fee to good ones. That does not mean you buy every dip blindly. It means fear is information. Then you follow rules, hard rules. Only invest money you will not need for years. Preferably 5 or more, ideally 10. This is not rent money, not next summer, as vacation, not emergency cash, long-term money only. Second, prefer diversified funds unless you truly know what you are doing with individual stocks. Third, do not use borrowed money unless your income is stable, your plan is mathematically sound, and you could survive being wrong. That last rule matters because leverage is what turns an intelligent idea into a life, ruining one when used carelessly. Now let us come to the present. Early 2026 does not offer the same picture as 2009. Nobody honest would say that. The world is different, the market structure is different, the policy backdrop is different. But some patterns rhyme. We have had meaningful volatility. Certain sectors have come down hard. Many growth names have been punished. Interest rates stayed higher for longer. Consumer confidence has been shaky. Economic growth has cooled. The fear is not at 2009 levels, but the shift in mood matters. What I am saying is not, "This is definitely the bottom." No one who knows anything speaks that way. What I am saying is that periods of fear, valuation compression, and public uncertainty are exactly when long-term investors should begin paying very close attention. That is the right posture, not certainty, attention. This is especially true in technology and growth. A lot of garbage was priced as genius during the euphoric years. Good, that deserved to be punished. Some of those names are still garbage, some will never matter. But mixed into the wreckage are real businesses with real revenue, real profits, real future value, and much lower prices than the crowd was willing to demand a few years ago. That is where work matters. Not all beaten down stocks are bargains. Some are simply broken, but broad market exposure solves much of that selection problem. You do not have to know which specific company wins if what you are really betting on is the long-term resilience and recovery of the productive economy itself. This is why I find the history so useful. After deep fear, the gains are often explosive from the 2009 bottom to the next year. The S&P 500 jumped massively from the COVID bottom through the end of 2020. The rebound was violent. That is how recoveries often look, not polite, not gradual enough for you to wait until things feel safer. They happen while the public is still arguing with the data. That is why the person who waits for comfort so often misses the richest part of the move. By the time CNBC is cheerful again, the discount is gone. By the time your friends start bragging about gains, the easy phase is over. By the time the headlines stop feeling dangerous, you are paying higher prices for lower future returns. That is why timing matters. Not in the childish day trading sense, in the regime sense. Recognizing when fear has pushed prices away from value. Recognizing when a crash has turned great businesses into sale items. Recognizing when the public is so dominated by present pain that it can no longer imagine normal recovery. That is the moment worth respecting. Now, I need to be very careful here. This is not a license for recklessness. I am not telling you to go all in on meme stocks. I am not telling you to invest your grocery money. I am not telling you to quit your job and stare at candlesticks. I am telling you something much simpler and much more useful. If you have long-term money, if you understand that markets move in cycles, if you know fear will come again, then periods of real panic should be treated as opportunities to prepare and act, not just as reasons to hide. This is what separates the crowd from the builders. The crowd buys high because optimism feels safe. The crowd sells low because fear feels urgent. The builder learns to reverse the emotional logic, not recklessly, intelligently. He understands that every generation gets a handful of true buying windows, not dozens, a handful, 3 or 4 moments in an investing lifetime when fear becomes so dominant that strong long-term assets get sold below what history suggests they are worth. If you capture even 1 or 2 of those windows properly, your financial life can change in ways that ordinary steady state investing alone might take far longer to achieve. That is why these moments matter so much. Not because they come often, because they do not. Now let me bring this home. 10 years from now, people will probably look back on this era the way they look back on the previous major corrections. They will say, that was the time to buy. That is how history always sounds after the fact, clear, obvious, easy. It was never easy, it was merely available. Availability is not the same as accessibility. The opportunity is available to many people. It is emotionally accessible only to the prepared. That is the lesson I want burned into your mind. The next time the market crashes, and it will, the people who profit most will not be the ones who are surprised by it. They will be the ones expecting it. The ones who had cash ready, the ones who already knew what they wanted to buy, the ones who understood that fear was part of the price of admission, the ones who had decided in advance that panic was not a signal to run, it was a signal to start paying attention. That is how regular people become millionaires during crisis windows. Not by brilliance, not by speed, by preparation plus patience. And if you can build those two things into your financial life, then the next great market sell-off will not only terrify you, it will invite you. That is the whole difference between the crowd and the people who eventually outrun it. The crowd asks, how bad can this get? The builder asks. What great assets are now on sale? Because everyone else is asking that question. That is how fortunes get built quietly, uncomfortably, rationally. And always before the newspapers admit it was the obvious move.